Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Matt Bivons, the founder and CEO of Canopy. I've been looking forward to this conversation because Canopy kind of sits on what I think of as the often overlooked and underappreciated part of lending, which is the servicing side. It's really interesting, the servicing platform. But I think importantly, we dive into a couple of things that are really interesting. How servicing is really the footprint for cross-sell and customer relationship management on an ongoing basis with customers, which is a really important part of the financial industry business model. We talk about how often the kinds of products you can offer are limited. And I've seen this several times by what your servicing capabilities can support. So even though you may be able to think of an idea of a different kind of loan or a different kind of payment structure, you really have to have the servicing platform to be able to support that. And finally, why commercial side servicing can be a little harder than consumer, and why we've seen some people kind of mess that up because the variety of products and different ways those are used. So I thought a really interesting exploration of, again, an sometimes overlooked part of the lending lifecycle, the servicing side, and all the value that can be created there. So please enjoy my conversation with Matt Bivons. Matt, welcome to the podcast, and thanks for making the time to join us today.
Thanks, Jeff. Really happy to be here.
I'm excited for this conversation because I feel like a lot of the conversations I have about loans all center around the origination side. We're going to talk a little bit about the post-origination side today, which will be fascinating. But just before we get into that, for a little context, can you give people a little context on the company and Canopy, what you guys do? And my standard opening question is kind of how we all made our way into the banking industry, because I find that that's an interesting story. So maybe you can meld those two together and tell us a little bit about you and the company.
Yeah, sure. So Canopy is an API-first modern lending core. We help lenders be better operators through our loan management platform and suite of tools. And so that's a little bit of who we are, what we do. To your point on post-origination, that's really all that we focus on. So everything from getting approved to taking a loan all the way through charging off or closing an account. It's about 90% of the loan's lifecycle and engagement happens in the world of servicing. But we don't talk a lot about it because it's a little bit esoteric. It's not that sexy, I guess, for some, although we're doing a whole podcast on it. So I hope there's some people out there that are interested in it. And servicing powers the lending ecosystem. So our platform connects into a lot of other integrations, from payments to issuer processors to KYC, to help operators be better lenders. And so when I think about servicing, I'm thinking about any company that has to account for its customers making payments needs to service them. DoorDash services you, Uber services you when you have a problem with your ride. But when you're dealing with financial products, you also need a system of record that can handle all the rules and policies that govern those products. And so servicing is a very, very big landscape. As for me, I've been in FinTech for about 10 years. I was out in the Bay Area working at a couple small payments startups before moving on to a company called Earnest. Earnest competed in the heyday with SoFi, really one of the first modern neobanks back in 2015, after Simple's acquisition. And I got to see firsthand everything from originations to servicing to securitization. My job was to help grow origination. So how do you price, underwrite, acquire students? Servicing was how do we account for these students making repayments? That was quite a nightmare and have some PTSD, which helped me found Canopy. And then securitization is when we sell the loans into the capital markets. And so we tried to build everything in-house. I would say we were big tech, little fin, if you think about the two sides of FinTech. And we didn't need to recreate a lot of the wheel. We didn't need to redo it ourselves. And so we tried to do everything in-house. Obviously, there weren't companies like Canopy at the time, so we didn't really have another choice. I think it's one of the reasons we prematurely sold the company, because of the difficulty in getting data accuracy and precision to get the loans into the capital markets. And as that acquisition was coming to fruition with a company called Navient, which is the largest student loan servicer, I was recruited through some friends at QED to a company called Green Sky in Atlanta. And Nigel Morris said to me, "This is the most profitable FinTech that you've never heard of." And he was right, because I hadn't heard of Green Sky. I hadn't been to Atlanta, but it was amazing. They were doing about 250 EBITDA when I joined. I joined to be their head of consumer. So how do we grow out their consumer arm? For those who don't know, Green Sky was really one of the OG point of sale lenders before anyone said buy now, pay later. GreenSky was the leader in that. And got to ring the bell in the NASDAQ, saw them pre and post IPO. And they had the same struggles with servicing as Earnest had, just on a much bigger scale, which was that it was very difficult to make small line changes within the database because the database was 15 years old, extremely rigid. And so I started Canopy to be a more flexible, fungible option for banks and FIs to launch more innovative lending products.
I love that connection because it's easy to forget that often the servicing capabilities end up dictating the terms of loans or the way we, for revolving credit, the line changes, increases or decreases, end up being like limited in many ways. Like the innovation is not like it's not like people haven't thought of new kinds of loan products. It's like, oh, I can't do that because even though I can originate it, I have no way to collect money in this or that way, which is just a fascinating reality that this kind of back end, seemingly simple process, right? Like how much do you owe? Do I collect the payment that doesn't seem like that complicated a part of the business in many ways. And yet it ends up limiting the kinds of loans that are made available and where they're made available and how because of the difficulty in changing those servicing terms.
100% agree. I mean, my slightly spicy hot take is that most lending products today are a commodity, right? I mean, as much as we wanted to be doing something different with Earnest, a 3-year loan is a 3-year loan. It's the same that Wells Fargo has, same that Bank of America has. Now, one of the things we did see at Earnest was a lot of students wanted non-traditional loan terms, 2.5 years, 3.1 years. Those nuances of personalizing those lending products became very complicated on the back end. But if you put yourself in the shoes of, a consumer in the middle of the country, maybe they only have one credit union in their town. That's all they have access to. And so if they get denied for a 3-year loan, they're immediately bumped up to the next tier, 5-year, 7-year. There's no option. There's nothing in between. And it's because that credit union or community bank is most likely on Jack Henry. And Jack Henry's had a fixed set of rules for 50 years. And making any type of change would literally blow people's minds because you don't know what happens downstream. And so there's the commoditization of lending products. And that's one thing that we're looking to change. But then if you put yourself in the shoes of the operator, imagine you're a call center operator. It's not typically a career in the US, high churn. So you're managing a call center and you're constantly having to retrain people on systems that were built 40 years ago. Now at GreenSky, we had something between 10 to 15,000 phone calls a day come into our call center. And most were basic questions. What's my payoff amount? How much do I owe? And the call center agent would have to jump through screens and PDFs. They look like a Bloomberg terminal. They had 3 different screens of jumping in between things. And every minute they're on the phone, every second they're on the phone, is increasing their cost of service. Exactly. So we're hoping to also on the other outside of the personalization piece, automating a lot of these workflows so that simple questions the consumer can just know instead of having to dial a phone number.
Let me ask this because I'm kind of curious. Are there any innovative terms? You talked about financial loan products being kind of commoditized. And I think you can argue about like the amount you're approved for and the rate, but you're really competing at that cost level because you're right. The product itself, the core of like, you get a 36-month loan or a 60-month loan, you make monthly payments, it's simple, whatever. Those things are kind of like industry norm. And you mentioned like terms like 2.5 years or which is kind of like just the duration of the loan, which shockingly can be very hard for servicing to handle. I mean, it's like I'm just counting it in months instead of years. It should be easy. Just change the number. But are there other kinds of terms you've seen interesting innovation on for some of your customers where they're actually saying, hey, here's a kind of product or something other than just the duration of, let's say, an installment loan that can be changed in interesting ways to change the nature of that product in some way? Because you're right, there's not a lot of innovation on that actual, like, what is the core offering that's being provided front?
Yeah, so we at Canopy, we support pretty much every type of unsecured lending product. So from revolving cards, charge cards, debit cards, installment loan, buy now, pay later, student loans. And then on the B2B side, we have a lot of working capital products. So merchant cash advance, invoice factoring. So I'd like to tackle the question in 2 sides. So on the B2C side, there are a lot of personalization from our lenders that are looking to extend grace periods, or maybe give a revolving line of credit that can retroactively put a purchase onto an installment plan. Amex has this today called Pay It Planet, but it's in their Amex ecosystem. We've helped democratize that. So there are a lot of, I'd say, beneficial viewpoints that our lenders are doing to create some differentiation within the B2C space. In addition to simple things like changing up interest rates or choosing a transaction and putting it retroactively on a buy now, pay later product, very complicated from operational process. We help simplify that. They are also trying to answer questions for consumers before they happen. So as an example, if you were to call in to any of the lender today, any credit card lender, and you said, hey, I'm thinking about making this big purchase. What does that do to my interest rate? That lender can't answer that question because their system doesn't provide that level of transparency. And so that's really what we mean by better operators. We're helping provide more financial literacy to the end consumer, the end borrower. Now, again, I'll kind of pause there because I think there's a lot of innovation happening on the B2C side, but generally that playbook has been extended. I mean, it's been, you're not really going to out innovate Capital One in a consumer credit card space. They have too much, unique proprietary spending data to do that. On the B2B side, I think that it's really a blue ocean. I mean, there is so much opportunity. KYB, know your business, is still new. Obviously, you're not using FICO scores. Cabbage is one of the most modern B2B lenders, and they're only 10 years old before they merged with Amex. So we're seeing a lot of unique use cases for working capital products that companies like Flexport, one of our portfolio companies like Novo, is a small business lender out of Miami, another one of our portfolio companies, are really pushing the boundaries in this space. And so I'm excited to see where the B2B side of lending goes in the next couple of years. Interesting.
Yeah, the B2B space will be fascinating. So I want to switch a little bit to this, I think the interesting touch points that you get on the servicing side, because while servicing, I think it's thought of as kind of like rote. It's also to your point, like 90% of the life cycle of any lending product happens post originations, and so much time and energy is spent thinking about how we originate faster and whatever. And yet, most financial industry companies, their business model is built around cross sell, and so it's interesting that 90% of the life cycle of the loan is in the thing that we spend less time talking about. And yet that's really your surface area if you're thinking about digital or automated or self-service to actually cross-sell and help people find new and additional products. So I'm curious how you think about that, because it is this kind of really interesting thing that in some ways it's natural. You just got to collect the money. It's the easy part, but it is also like that's your touch point on a very regular basis with your customer for most of the time they interact with you. This is how they interact with you. And that's your place to talk to them about other ways you can work with them, which is a pretty valuable piece of real estate, actually.
Yeah, I love that you brought that point up. I mean, it's really one of the founding principles of Canopy. So my thesis is that every FinTech, every FI out there moves from a mono-product world to a multi-product world. So banks have been there for a while, which extends the LTV of the borrower. But FinTechs are still somewhat a one-trick pony. And I think, they're needing to get beyond just basic interchange, and they have to get into lending to continue to sustain and grow into their valuations. And so if you break that down, when I was at Earnest, we had multiple products. We had a mortgage product, personal loan product, and a student loan product. We wanted to be the universal system that could have better data through looking at the other side of the balance sheet. So we were one of the first companies to work with Plaid to start using that in underwriting, and be able to say, oh, this is Jeff. He went to this college. Here's his repayment data. He's about to reach this other milestone in his life. We should instantly approve him for a mortgage or instantly approve him for a personal loan. Now, in theory, that sounds amazing, but incredibly difficult to do when each of your products are in different servicing stacks. This is something that SoFi is going through right now. They have multiple products. They've had that for a long time. Each are on different servicing stacks. And so my brother's a SoFi member, and so he's been repaying his student loan for some period of time. They should know him front and back and understand his risk. But when he goes to look at a personal loan, it's a brand new customer. And so having one system that has universal data is a major advantage point. And that's why it was important for us to be able to support multiple product constructs out of the gate. I think that servicing systems, and I'd be interested to hear your take from Upstart. Servicing systems are a major point of engagement. So most of the companies we work with, they want to own that relationship. They don't want to offshore that to some random call center, the other side of the world. They want to be able to answer and engage with their customers so that they're not having to reacquire them and they can actually cross-sell and upsell, like you said. But all of that data exists in the servicing layer.
Yeah, no, I think it's a huge point that this is an area that's often underinvested in. Even I think Upstart, we've historically kind of servicing has not been as front of mind in terms of place for innovation. And yet when you get to the real cross product and you go, well, how do we like be smarter? I've told financial institutions for years that like, if you want to earn repeat business, you got to get people, you should be able to give the best rate and the simplest process to your current customers because you know more about them. You have their servicing history. You have all the data they used to apply the first time, right? And yet so often, I mean, your example, I had a mortgage with a bank. I said, can I add a HELOC to that? And they said, sure. And they sent me like a blank application that started off with like, where is your house? Come on, guys. Like, take advantage of what you have to give me something better. Because if you don't, I'll go ask 5 other guys who are going to give you the same process you can, and you've lost your advantage. And why am I loyal to you? You didn't make it when that HELOC should have been like, do you want fries with that? Like you get the mortgage, it should just be like, hey, we have fully underwritten you. Would you like, $100,000 HELOC to sit on the side of that when you're going? And it should just be a checkbox in my paperwork, right? And instead, it's like a 5-page application, and you go, that's a totally missed opportunity. Probably because the data was just like didn't speak, right? It couldn't. Everybody knows that they should do that, but it didn't. Technically, they couldn't do it. It's mind-boggling.
Old system of records are very rigid, very difficult to extract data, to manipulate it. They're almost always in a batch process. So everything with Canopy is real time. So we're giving our operators, up to date in real time access to repayment data, transaction data. It helps banks and lenders of records and capital markets log into Canopy and see exactly the risk scores that are coming on to make better underwriting decisions. So having access to real time data is a major starting point to this. And I think that's FinTech's promise, right? FinTech's promise is let's create a better customer experience. I think that for a while, the first wave of FinTechs were only like a front end marketing site. And it's because the technology underneath of it couldn't actually help create better experiences. And so I'm excited for the next 10 years for exactly that, which is let's be able to utilize data to make instant product offerings, reduce friction, and actually create, that's FinTech at its best, right? Facilitating better life experiences, the home that you live in, the car that you drive in, the school that you go to. Let's actually see that all the way through by not making people painfully go back through a manual process on just basic table stakes information that the bank or the FinTech already knows about you.
Yeah. And take it a step further and actually like recommend the right product because you know what's going on in my life. Give me a better rate because you can see my repayment history in a way that's not directly in the credit file. Those things they're available, they're possible. It's not really a technical challenge to do them, but it is a technical challenge to get a legacy system and get the data in the right capability to do that. I'll tell you, my SoFi story was even worse than the one you told because I got a mortgage through SoFi. It's not the same one that couldn't give me the HELOC, but they'd outsource the servicing. And so all it said, we know you got a mortgage from us and this is how much it was, but we have no idea what the balance is or where it's at or when your next payment is or what your payments are, because that's click here to log into the third-party servicing site. And I went,
and then you're making repayments to a company that you don't even know. And so you're like, is this fraud? Is this a scam? I thought I'm a SoFi customer. It's like, no, you're like this other bank that you've never heard of.
Servicing rights and the whatever, and has a website that looks like Craigslist from the 90s. And, you go, that's not, it's fine because I got a good rate, but apparently all I got was the rate and I didn't get a better experience. And I was an early SoFi customer. So I don't want to like put SoFi in a bucket today of what that experience is, but I do think it speaks to what the experiences that are often offered today are and what the opportunity is. Because I was, ready to have an integrated experience, the opportunity to see all my products, make a combined payment. Can I understand what my total monthly obligations are to the financial institution? Can I combine payment dates or split them up or understand how those things interact? It's a really fascinating area. And it is I think it's ripe for really delivering on the promise of, better technology and financial, whether it's a forward-looking financial institution or a new startup fintech company, there's still a lot of promise left to deliver on.
Well, I think that this is where embedded lending gets me really excited, because if you have companies that aren't necessarily traditional lenders, obviously a company like Walmart who bought One Finance, or a company like John Deere does lending. Nothing runs like a deer. They lend and rent off of their tractors and mowers. Even Peloton's effectively a lender. They just use a firm to do it. And so companies can bring this service in-house. They're already best in class operators and put their customer first. And if they layer in financial services as well, that just adds to such a more holistic experience with the brand. And so I think that companies that are already doing lending that have a bunch of fragmentation, certainly it's hard to piece all of that together. But you have this new greenfield opportunity of new fintechs, new FIs, or great brands that want to bring in financial services in-house. And they can have a fresh, clean plate to start off with a company like Canopy that can help them launch multiple products simultaneously that are complementary to what their core service already is.
I'm curious how you think about that, because it's a really fascinating, this kind of embedded finance. And let's just take the Peloton example, because in many ways, I think people feel like they got a Peloton loan. That's what it's for, right? As my feed, but it's really through a firm. And how do you see that playing out? Like, I don't know that Peloton really wants to be the lender, like from a balance sheet point of view and a risk management point of view. And I don't know if a firm cares about owning that customer. Like, how do you see that playing out between the brands? Do they really become lenders in some real way? Do they really partner with forward-thinking banks and FIs? And how do those FIs think about the kind of customer value they get out of a Peloton customer? Do they think of themselves as an Affirm customer too? Is Affirm getting a great chance to cross-sell, or is that all that brand equity accruing to Peloton? It's, to me, a fascinating time to see how that plays out between these large brands that consumers are going to and the partners they're working with on the financing side. I think it's just fascinating. I'm curious how you see that kind of playing out. What your advice is to a fintech or a bank who's looking at space, going, where do I fit into this ecosystem, and how do I think about what that opportunity looks like for me?
Well, I think that there's certainly a rebundling of services at brands, and in a raising interest rate environment like today, giving up 7 to 10% take rate for your partner who's actually the BNPL is lost economic value for you as the brand. And so there's the financial side of this, of like what makes sense for us to bring in-house. And then I think there's also looking at your core competencies of what do you do really well. I mean, are you already servicing your customers? I mean, are you the one picking up the phone? Are you the one sending out mail? Are you the one that is recommending, in Peloton's case, different classes to take? And so you can. There's so many great infrastructure companies today. I mean, Canopy plays a part of this, but companies like Alloy on the KYC side. Companies like Dwala or Checkout.com on the payment processing side. So I think you can really pick and choose a la carte, best in class infrastructure services, bundle these items together, and this helps accelerate your ability to launch lending products in-house. Now, again, when you look at your core competencies, and this is often a conversation that I have, not just with brands, but banks and fintechs as well, creating a servicing layer and managing all the rules and calculations yourself is a very high bar with not a lot of differentiation for you. And so Canopy can come in and accelerate a lot of this, because you should focus on what you do best. And so I think that's like the first principles question is what does the brand do best? How can they extend that related to financial services? And then can they pick and choose a few vendors that allow them to bring it in-house, which again is a win-win-win. The customer doesn't feel like they're getting passed around to different providers, and the brand captures more economic value than losing. I mean, Peloton basically gives up 10% of every sale to a firm, at least. And so to me, that's where it's like, it's a no-brainer to bring it in-house.
Yeah, that feels unsustainable over time. Like, there's no way I don't take a bite back at 10%. I like running my business at a 10% discount. That's
exactly
where my economic model work well. That kind of
right.
take. Interesting. It's a fascinating space. Do you see anything? I mean, I wonder if there's anything we learned from the auto space where the manufacturers went into actually became banks in many instances to be able to offer that. And when I look at those companies now, they are trying to bring the user experiences together, right? To say, hey, we want a holistic picture of the customer who bought a car from us and an ongoing relationship with that customer. That's something other than the unfortunate thing for a car is like typically your ongoing relationships only when things break. It's like I bring it back to the dealer for servicing, which is like, in this case, not making payments. It's like, well, it is making payments, but because something on my car isn't working the way I wanted it to, or I need some help, something, needs fixing. But they love having the ongoing relationship from a financial point of view and kind of the ability to combine the economics of the lending. And I wonder if that's a model we'll see any of the other big brands march towards, where they actually have their own kind of the original embedded finance, if you will, in a very serious way. Like they like really own banks.
I think that is a really interesting take. And I think there is some comparisons there for sure. I don't know that a fintech or a brand needs to be the licensed lender of record per se. I mean, I think that that's still where, we've seen the chartered fintech story kind of play out. It's a very, very high bar, creates a massive amount of risk and compliance for the fintech. So I don't know that necessarily will happen, but I do, to your point of kind of combining the experience, I think matters a lot. I also think the product type matters. So in auto, for me, like I set up auto pay and I never think about who I'm paying. But there are other, like card-based products, for an example, have a much higher contact ratio, much higher touch point. If your card is declined when you're waiting in line at Home Depot, you're getting on the phone. And so, I mean, if you are calling in with an issue, do you really want to pass that down the chain 3 different times? And then you finally get someone who is reading from a script and doesn't really care about you at all. I mean, it's a horrible experience. So I think being a first party servicer, if that is core, if operational excellence and execution is part of your brand DNA and how you run your business, then this is just a slight extension from to offer financial services. I think it makes a ton of sense.
Yeah, and it really is that. I think you're right that the 2 things I take away from the conversation are the ability to really innovate on what you can offer and the ability to really optimize the customer experience, whether that, for any kind of touch point. But it's amazingly true how difficult it is to have. I mean, even most banks, if you dial in and go, what 4 loans do I have outstanding and what are my next payments? Like you may end up in 4 very different UXs because those are 4 different systems. My credit card balance is over here. My auto loan balance is over here. My mortgage balance is over there. And bringing those together is so powerful in the world where, customers are looking for that integrated, simple experience. And you have to have the right data layer to provide that.
I feel like you just gave me a layup. So I gotta talk through this example because that is exactly what we believe in. And in the B2B space, it is so painful because you're running a small business and you call up a bank and you're typically getting multiple lines of credit. So you have 1 to pay your inventory, maybe 1 to pay your payroll, and 1 to pay your rent. So now you have 3 different loans, 3 different account numbers, 3 different min pays, and you're trying to run your dry cleaners or your clothing store. And so you call into the bank and say, hey, I'm trying to find what's my minimum due. And the bank says, for which account number, sir? Well, I don't know about you, but I don't just have my account numbers just off the top of my head. So now I'm fumbling through to find the account number. We're going back and forth. And before you know it, I missed a payment because I thought it was the other, the working capital product, but it was actually for the rent. And so Canopy helps consolidate a lot of that into a single min pay, single payment, single due date, single statement, so that both the borrower and the operator don't have to handle all of that complexity. On the B2C side, so not so much as having multiple accounts or loans, but for me personally, I have a Capital One credit card, and I called into Capital One about a year ago and said, I'd like to know my payoff amount. They gave me a number, and 2 months go by, and Credit Karma dings my credit score. And I call up Capital One furious. I thought I paid off my account. And they said, well, sir, actually, it was mid-cycle, and you had some residual interest rate, and then you got a late fee and a late fee. And I was pulling out my hair Jeff. I said, please just tell me, how much do I owe today, right now, on May 22nd, whenever it is. And they couldn't tell me that information. And so being able to just give transparent, real-time information that seems like table stakes is challenging for some of the largest issuers in the world. So there's how do we make it a simpler, better user experience to consolidate all of these loans and accounts under one statement, one MinPay? And then there's also how can I just give people access to information when it happens to be mid-cycle?
Yeah. Let me ask you one more question before we wrap this thing up, because I'm really interested in, I don't know how much you guys work with more traditional FIs with established products and history and migration of data in how versus startups who are kind of building from scratch and going, hey, this is great. But like, what is your advice to a financial institution that maybe has some history? Because we need to move to an API oriented, real time, better system of record. But like, we got a lot of data, we got a lot of people in flight, lots of loans outstanding. That kind of movement from A to B, it's easy to go, yes, this would be a better world were I to be living in it. But I got to move my house and all my stuff and get from A to B. Are there any best practices or things you've seen for companies, institutions that are a little older that say, hey, I've got some history here. How do I make that transition to a better world without breaking the bank and breaking the institution? That feels like a really hard challenge. It's very different than, hey, I'm starting a FinTech company. I want to have like a better servicing experience and primary record system. Like I can start from scratch. So what's your advice or history with that? And what would you tell institutions that are trying? How do I start the process of getting to a better place?
So Canopy works with several top 25 issuers on this exact problem. And so it's a combination of technology and people. So it takes some of our solution architecture team to actually help. So it's not just automated, because every bank might have multiple databases that have different naming conventions. And so we need to normalize all of that. And so it is a process of figuring that out. And we help white glove handhold these banks through this. It is also based on the technology. So our technology from retroactive events can pick and choose a time in the past, but it could be created 3 years ago. The account could be created 3 years ago, but make it effective today. And so we have a migration mode in our API that rolls time forwards and backwards. Time is the thing that is really a sticking point with this, to make the data migration piece easier after the naming conventions are agreed upon through our solution development team. So that's just a little bit of like insider baseball, how the process goes down. I would say if I was giving advice to a bank, don't go through a digital transformation effort. I hear that word often, and that typically is a 5-10 year journey. And so you have to start somewhere. You start small. And so sometimes Canopy can be a shadow ledger and system of record against one of the existing cores and make sure that all the test cases and rules and policies are set up. And we pick and choose typically a division within the bank and say, by working with Canopy, we're going to show you how we can help you acquire more merchants. We're going to show you how we can help increase your repayment rate. We're going to show you how we can decrease your cost of service through different automations. And we typically run a pilot program side by side. So it doesn't feel as overwhelming as migrating 50 million cardholders over to our system. So it's a little bit of land and expand, along with a combination of technology and people from Canopy that really make it less painful. I mean, that's my view of the world in general, is that if you're selling into B2B like we are, like we have to take on that pain so that our customers don't have to feel anxious about it. And so that's how we approach it.
Yeah, I love the land and expand, maybe as a sales side version of that, but to kind of like start with a test case, prove the technology, work it out, maybe run it in the shadow background. Those, I think sometimes it can be almost impossible to imagine the whole thing, but I've always found these kind of transitions work best when you can launch something, show value, show success, then go, versus trying to get everybody on board to go, hey, let's all do the thing. You go, let's get one guy who loves it. Let's get one group that's using it and sees the value. And then you go, hey, we've already done 40% of the work for you because it's just set up or through vendor diligence, all that stuff's done. And now we start expanding the value over time. It's always easier, I think, to do that when you're seeing value internally as an organization to say, hey, let's invest more in this technology, this partnership, this whatever, than to start with like, oh my God, we got this huge thing we have to do. And the stakeholder management.
Well, we have a lot of stakeholders, right? So when we sell into a bank or a large established lender, there might be 5 or 6 different individuals that all have different value propositions in their head. The head of operations, the GM of lending, the CTO, the CFO, they all have different objectives that they're trying to solve for in their orgs. And so we need to be flexible of understanding their pain points and really talk through how a modern lending core like Canopy can really help accelerate them. But this is not for the faint of heart. It's not, bottoms up, self-serve. These are complex sales, complex deals. I mean, these are systems that touch a lot of other systems. And so we spend also a significant amount of time working through integrations. So making it really easy to add on your CRM of choice. We integrate with Zendesk, HubSpot, and Salesforce, or you can use Canopy. Integrate your payment processor of choice. We work with Stripe, Dwala, repay.com, authorize.net. So really pick and choose and make those integrations easier, because every lender has a different suite of services and tools that they use internally. And so we're not going to force you into just one platform. We're going to be the core for you. And then we're going to help you navigate all of the other products and third parties you need to continue to run your lending program.
Yeah. One maybe piece of advice I would give to the FIs listening to this, or the FinTechs, is like, the fact that it's hard, to me, makes it a competitive advantage if you can do it well. Because many people look at the hard thing and go, it's too hard, we can't get it done. And if you can, which is not trivial, but it puts you in a position to actually deliver those customer experiences that differentiate you in the market. And so I remember when we were starting Upstart, my CEO used to look at me and say, how hard, sales or whatever, how hard is it? It's really freaking hard. I go, that's good, because that just means it's going to be that much harder for somebody to come behind. That's a competitive advantage that you're building through doing that hard work. That will take anybody else who wants to copy it, like, just as much time and hard work, and they're starting out behind you, chasing you. And I think that's a tremendous advantage for the institutions to can figure out how to get it done and how to get it moving. So well worth the effort in the end.
I agree. I mean, I think it's also why, as a starting point, so many fintechs went to debit. I mean, part of it was Marqeta, Galileo, Lithic made it easier, so it became a little bit of a self-fulfilling prophecy. We definitely hope to make offering lending products simpler as well, and getting to market faster. But as you look to move beyond just debit and you look to move into something that is not just interchange based, I think it's really important to think about the compliance and safety piece to it. So obviously our system out of the box is compliant. We help navigate the different geos and laws that are a part of it. It's thinking about the end borrower experience. How do you replicate Jeff's account in month 6? Because it's the edge cases that make this really hard. So we have a lot of tooling. We have a product called Loan Lab that enables our customers to simulate things that have not happened yet, so we can show you that they are always true and show you what this would do to your portfolio if your delinquency rate went up to X, as an example. So simulation of time, being compliant, and really helping to navigate all of the different pieces you need to offer a lending program is what we love. But to your point, it's not like something you can just turn a switch overnight. Lending is hard. Doing it well at scale is very challenging, which is why, I mean, a lot of the banks and issuers continue to maintain the majority of the engagement and assets, because of the integrations and being entrenched in a lot of these processes. Now, on the counterpoint to that, I think a lot of the issuers are thinking about getting disintermediated by up and coming fintechs, companies like Afterpay, Klarna, Affirm. And so how do you merge the knowledge and operational excellence of being a great lender with the technology that can allow you to offer more unique and innovative products is really the intersection that Canopy sits in.
Excellent. Well, Matt, this has been a great conversation. I love that we got to dive into the 90% part of lending, not just the 10 that we end up spending so much time focusing on. I got 3 questions I ask everybody at the end of the podcast. So if you're ready, here we go.
Let's do it. Rapid fire.
Number 1, what's the best piece of career advice you've ever gotten?
Best piece of career advice. 'Cause, your career is not linear. There's ups and downs to it. And so there's peaks and valleys, but it's how the trend line goes. And so that means that for me, as an example, all the rejections, like, don't take it personally, understand where you're going, take it with a grain of salt, but work to get better and persevere. And so I think grit in your career and knowing that it's not easy, it's not given to you, is some of the best advice that I've gotten, and something that I try to abide by and tell my kids as well. I'm in my son's room because the audio quality is the best here. So, it's a career advice and a little parental advice as well.
Anything that can double as career and parental advice is good advice in my book. That's a double win. Second question: what's the best advice you've ever gotten about the general consumer financial space or consumer lending space in general?
That as much as people try to innovate FICO's pretty innovative. Boiling things down to a single number is innovative. It's not great, but it's 30 days lagging. But Fair Isaac did it right when he boiled it down to a single number. And so I think there's a lot of people that try to create alternative data structures and not use FICO at all, and collecting more information. We used to always joke is reverse innovation. So that would be my hot take on the consumer side.
That is a hot take, especially talking to a guy who works at a company that uses alternative data to underwrite credit. Everybody, we bring you on to hear the guest opinion. So we'll find a different time to have a debate about that topic.
Okay.
My third question is, what's one bold prediction for the future?
I think that AI is going to continue to advance in financial services. Obviously, how that takes shape and form is going to be interesting, as if AI is 99.9% correct, but off on that 0.1% of the time, it's not good enough. Financial services, you have to be 100% correct all the time. The precision and accuracy makes it really, really challenging. But Canopy, we've been using machine learning and automation to make better workflows and predictions to our borrowers already. So I think that trend is going to continue to accelerate. And then, as I mentioned, I'm really excited for the future of B2B lending.
I like it. Let me ask this. Have you guys seen anything on the Gen AI? Because the generative AI is interesting because you can use it. I mean, my kids use ChatGPT, or they actually ask it questions and want the answer to be good, which is maybe not the thing it was built to do, right? It's more of a writer. But if you think of it as a natural language interface that can understand what you're asking and then query an underlying system so that the answer is accurate, it becomes really interesting, right? As a way to replace an agent in, let's say, a chat where it has access to a Canopy to say, hey, what's my balance? It goes, oh, I know what you want, and I know how to get it. And I can now have like a more natural conversation with an AI. Are you guys looking at things in that space? Because I think there's the AI as the back office, your point, machine learning, that's actually, I think, here much more than people appreciate already being done. And then there's the Gen AI has been more of the front end, the user experience shifting to this kind of more human-like interaction that's not actually a human. And I'm curious if it seems like something that may be coming sooner rather than later to servicing experiences where you can have a conversation that's not powered by, at least initially, a human, but by an AI that's connected to internal systems. And I'm curious if that's something you guys are playing with or looking at or have any thoughts on that.
Yeah, this was a similar question to I received at FinTech Nexus a couple weeks ago, and the polling suggested half of people said they want it to be a chatbot and not talk to humans, and then the reverse was true too. The other half of people said they want to talk to a human. So I think it's complicated, it's nuanced. I think for really basic things, sending a text message to know what my balance is, to be able to make a payment, anything that reduces friction there, I think is really, really helpful. And obviously AI can play a major role in that. I also think in terms of the relationship, sometimes you want to be able to talk to somebody and actually ask the person a question that doesn't feel so distant and cold. And so I think that the use case matters a lot, but I think all of us could say that we're not in love with any IVR systems and any phone systems. And so if this helps to make that just a little bit better, then that's a win-win for everyone. So we are looking at some of it. But the use cases are nuanced based on the product type and what people are doing. So I think it's still going to be a combo of data, automation, AI, plus human agent interactions for some time now.
Excellent. Matt, I appreciate the time today. This was a great conversation. Thanks for joining us.
Thanks, Jeff. Talk soon. Cheers.